this fascinating thing right now about almonds is you're dealing with this ballooning demand, but you're also dealing with supply that is struggling.
Yes.
The crop was down 7% last year. The U.S. makes about 80% of all the crops that we actually use here in the U.S. Right, California. And we have that horrible, horrible drought, and almonds are very water intensive. So you've had that issue. The USDA actually expects production to be down again this year. So because of that, you have the double whammy, and boom, you have those higher prices.
So there's a huge cost. Do you eat almonds?
I do, and I flirt with almond butter a little bit.
You're a peanut butter aficionado. I am.
It's true. But I do love almond butter. I went through that as well. The question is, what does this do on the retail level? Because you have prices are so high, you've seen other companies like Smucker's coming in or Hain Celestial that haven't been big players in this market are now coming into the market. Now, I was talking to Ken Shea of Bloomberg Intelligence and Bloomberg Industries, I should say, and he was saying, look, it's really hard to hedge these guys. There is no futures market for almonds like there is for, say, oil, copper, soybeans, and corn. You also don't want to hedge too far out. You don't want to secure your supply 1 or 2 years out because it's quite volatile. So a lot of these guys go direct to the source. Diamond, the huge player, they've helped to set the price level. What happens when you get other huge players that have big pockets coming into the market?
All right, and of course the insatiable demand from China, too. A lot of people first got hooked on almonds because it's a Chinese New Year snack, and then they decided that it's actually much more healthy than some of the other stuff, and it also shows that you're rich enough to afford it. So let's eat it year-round.
There you go.
All right.
Totally great point.
Alix, you're going to stay with me here as we show you how commodities prices have settled in your trading. We've got to start with crude oil because we're talking about these massive losses, and it's interesting in contrast to what you see in equities or even the Treasury market. Stocks are down, what, 2/3 of 1%, 0.8%, and crude oil intraday down 7.7%. What gives?
This is an unbelievable slide. I want to put this into context. That two-day
slide, sorry,
is the worst that we've seen since the end of March, and the daily slide we've seen is the most since November of 2014. Here's the kicker. No one knows why. And this is where it gets really perplexing. I've literally been on the phone most of the day trying to figure out what is going on with oil. The first thing is there was a technical level at around 54.08. So that sort of accelerated to the downside. You can see that happened.
What was it, like a 50-day moving average, 200-day moving average, something like that?
100-day moving average. But fundamentally, oil is getting hit so much harder than any other metal, so it doesn't make sense. It cannot be a risk-off trade because gold is not surging. If you're going to put your money into a safe haven commodity, you put it into gold. Well, that's not playing out. So that rules the risk-off trade. If it's a trade specifically related to China, for example, because the stock market there has slowly struggled, you just had a segment on that, then you'd see copper off even more because copper and iron ore are really the proxies for China, not necessarily oil. Plus, we've known about their imports in May for a while, and we're waiting for the ones for June. And Iran, yes, we are about 24 hours away from an agreement. It's sort of the time crunch. Will a deal get done? Some analysts are much more optimistic, but it's not like they're going to offload 1 million barrels of oil tomorrow. It's going to take a while to get back.
So is it just domestic supply and rig counts and inventory numbers that we're looking at?
Well, part of it is on Thursday we got those rig numbers from Baker Hughes that shows that there were 12 oil rigs actually added last week. That was the first time since last year, so that definitely could put sort of a pall on the markets. And you can see this chart here is you have Baker Hughes oil rig count trails the oil price by about 20 weeks. And we've seen that uptick in oil. Therefore, those rigs are not far behind. But Citi's View had a great note out saying you're dealing with supply and demand that are affecting the market. It was supply for a while, and now there's demand problems as well, potential issues. Nobody really knows how much China is actually using. They're importing, but maybe to fill their stock reserves, not necessarily for end-user demand, and that's really the question. And we got maintenance coming up. In the fourth quarter, we stop driving, and refiners go bye-bye for business. So what happens to the crude market then?